Let me talk to you guys. There's only three ways to lower your interest rate, not only in 2023, but since we've been doing loans. First is you actually buying down your interest rate, aka paying points to discount your rate from your own funds, from your own resources. The first way. Is it the best way? I don't know. That's something that you would have to determine. Secondly, do you have the ability to buy down the interest rate? That's a huge question mark in the environment that we're in, because not only are those of you out there that are looking to buy, not only are you challenged with the affordability, the monthly payment due to the higher interest rates, but the biggest challenge that we've had since I've been in the industry is coming up with the funds, right? The down payment and or closing costs to get into these homes. And now, do you have the ability to come up with your own funds to actually buy the rate down to make the home more affordable? But long and short, number one is you, the buyer, funding, buying down the interest rate at the time that you get ready to buy your home. Okay. Now, your lender will be able to walk you through that, should be able to walk you through that as far as what that translates into, as far as actual monies, how much monies it would take to buy down said rate when you get ready to lock, and for the duration of your lock term, to make sure that all that is understood. So your lender will go over that with you. But that's number one, you actually paying for those funds yourself up front. The second way you can buy down the interest rate, and it's common nowadays, the seller is bringing those monies on your behalf to buy down your interest rate. To give you a definition, simply stated, it's a seller concession, a credit given by the to the buyer from or by the seller. Lower your payment. This can be done temporarily, temporary buy downs. It's generally used in a higher interest rate environment to make your house payment more affordable. So payments are made more affordable for the first 1, 2, or 3 years. So you may have heard of a 1-1 buy down, a 2-1 buy down, or a 3-2-1 buy down. Those correlate to the years in which your payment will be reduced by the monies that the seller paid on your behalf up front to help you ease into the fully amortized payment. This is not an adjustable rate mortgage. It's a fixed interest rate mortgage that you, the potential home buyer, will have to qualify at the higher rate. But in essence, the seller is prepaying the interest, the difference in the interest rate for you for the number of years that you're in this type of program. Here's the deal. Those monies are placed in an escrow account, and every month when you make your payment, the portion of those monies that correlate to the term of the buy down, the temporary buy down, is paid from that escrow account. The reason this is popular now is because all the talking heads and folks out there are saying, hey, eventually interest rates are going to come down. To be honest and truthful with you, if you're someone that's looking to buy, hoping or banking on interest rates to come down, I would tell you to take a pause, because you need to know and understand that rates could stay elevated a little longer because of everything that's going on. So don't make the decision to buy a home using this great strategy, seller funded strategy, thinking that, hey, rates will come down. If they do, great. If not, you have to be comfortable with making the payment at whatever the interest rate is, that final interest rate, or the interest rate that we're going to qualify you with initially going forward, and keep that payment for however long it is until the time that you can reposition yourself. That's putting the real in real estate, okay? We're not just selling over here. We want you to be successful, if you will, as a homeowner. If you are in the market and you can handle a higher interest rate, you can use those things to your advantage, because there's not a lot of folks that can buy. And so as a result, it's not your money, not going to hurt you. And if you can handle that higher payment, it makes sense to use the seller's funds to not only help you get into the home, but help you potentially save a lot of money if rates do come down. And if not, you're comfortable with making that payment, if that makes sense. One last thing I'll say about the seller funded buy down or these temporary buy downs. Let's say you do a 3-2-1 buy down and rates do come down to a rate where you're going to refinance within that period of the seller funded monies that are in the escrow account. If you do refinance and there's still money in that escrow account, you get those monies. They're going to cut a check to you. So that is a windfall that you can either take those monies, and there's a lot of things that you could do. Hopefully you'll take it and apply it to your principal, i.e. lower that balance, or you could do whatever. But it is a great strategy. It's not the boogeyman, okay? The last way to make or to lower your interest rate is what I call the biggest secret that's out here, especially for first-time home buyers. Really, it's only for first-time home buyers, right? Those that have not had ownership interest in the most recent 3 years. And that is a mortgage credit certificate, an MCC. In essence, what a mortgage credit certificate is, it is something that the IRS has put in place, the government has put in place for years, and it's a tax credit. It's a dollar for dollar credit based on the percentage of the mortgage credit certificate. The deal is you have to know and understand or find a mortgage credit certificate in your city or state if they are available. And there are some requirements that you must meet as a first-time home buyer. That's one of them, but also income requirements. But here's the gist. In the state of Texas, that's the home state, the only state that we do down payment assistance. The MCCs that we utilize are 20% of the interest that you would pay in a given year. And as a result of that, there's no cap on the interest. Long and short, mortgage credit certificates are huge in this environment because interest rates are higher and you have a larger mortgage credit, not to be confused with the mortgage interest that you can write off within the parameters of that mortgage interest. So it is a huge win-win. Most people don't talk about it. Most people don't know about it. Most people don't know how to utilize it as far as lenders are concerned. And so that's the third one. I would encourage you to ask your lender of choice about the mortgage credit certificate in your city. If you're in the state of Texas and you want to know more about a mortgage credit certificate and how to utilize that, not only to further lower your effective rate of your interest rate, you want to watch this video right here. And so there you have it, guys. My time is up, but I thank you for yours. Let's be good to one another. Let grace abound. And until the next time, peace.